There were four companies in particular that I want to talk about right now, just given their size and importance, that released results last week. And these were Microsoft, Amazon, Alphabet, and Meta. So there's a term which is not really so relevant anymore, but it's called FAANG, the FAANG stocks. And this refers to the big five companies in the US market. So FAANG actually stands for Facebook, Amazon, Apple. I believe actually
Netflix was the initial one.
Netflix.
Yes, yeah. I believe that the N originally stood for Netflix, but it's we're calling this FAANG. The big five that
FAANG
is normally referred to here are Facebook, Amazon, Apple, Microsoft, and Google. But of course, Facebook is now Meta. Google is not Google. Google is Alphabet. So the term doesn't really apply anymore. But the whole point here is that these are absolutely massive companies, the five most important companies on the stock market. So if you add all of these up together, you're getting a market capitalization of upwards almost $8 trillion between these five companies. Now, let's just put this into context here. If you were to look at the NASDAQ, so these are all NASDAQ listed companies. There's about 3,300 companies that are listed on the NASDAQ. And there's an estimated market value of the entire NASDAQ exchange of about $19 trillion. So 42% of the value of the NASDAQ is just attributed to these five companies. And then the other 58% to the other 3,295 companies. So if you were to look at the S&P 500, which is the 500 largest companies in the US, the percentage that is attributable to these five companies is lower, but it's still about 23%. So these are incredibly important companies in the market. They absolutely move the market. They are behemoths in the global realm of the stock market. So why don't we just walk through these? We're going to talk about Microsoft first. So they released this week their Q3 results, fiscal Q3 2023. Revenue was up 7% year over year. And what was driving the strong revenue growth was a continued leadership in Microsoft Cloud continuing to grow about 22% in the quarter, 25% on a constant currency basis. Microsoft overall had operating income increase about 10% to $22 billion. Net income was up 9%, and earnings per share were up $2.45. So these results, they exceeded analyst expectations. They exceeded my expectations. Productivity business processes revenue was up 11%. Intelligent cloud revenue up 16%. And it was just the more personal computing division which saw a decline. So this is more of the hardware devices, and that was down 9% for the quarter. So as I said, this was a beat. The non-GAAP EPS of $2.45 beat analyst estimates by 22 cents. Revenue beat analyst estimates by about $1.85 billion. So great performance from the company, exceeding our expectations, exceeding analyst consensus. The stock has since increased 12% since the release of the results. Now, one of the big things we've been hearing a lot about Microsoft that we've spoken about as well is a huge buzz around their investments into OpenAI, which is the developer and owner of ChatGPT. So this is currently the most advanced artificial intelligence technology in the world. Microsoft has a partnership with OpenAI, and they are in the process of integrating AI across their entire software services suite. So one of the things that they have done recently is they've upgraded Bing with a new chat service, which is powered by essentially ChatGPT. So you can actually have a conversation with a search engine, which is somewhat unique. Analysts for fiscal 2024, they're looking for growth of about 14%. So their fiscal year, Microsoft's fiscal year, that actually starts in July, a little bit different than the other tech companies that we're going to talk about. But $10.93 in earnings per share, that would put Microsoft at a valuation of about 28 times earnings based on forward expectations. So great performance for Microsoft. Very interesting space that they're in right now with the AI. They've really propelled themselves to the forefront of the AI race. And then as well, performing extremely well in cloud. Their Azure cloud computing platform continue to increase market share in 2022, owning about 23% of the global share of the cloud computing market, which was up from 22% in the year before. Next, we will talk about is Alphabet, which is the parent company of Google. So they released their Q1 2023 results. Revenue was up 3% year over year. Google Search produced $40 billion in revenue. Google Cloud, $7.5 billion. About one thing that's important to note, Google Cloud, Alphabet's cloud computing platform, it is growing. It is acquiring market share from competitors. However, it is actually not profitable right now. So nearly all of the company's profit comes from Google Search. Operating income for Alphabet decreased to about $17 billion, down from $20 billion. Operating margin was 25% for the quarter compared to 30% in the same quarter last year. And then net income fell from $15 billion or $1.17 from $16.4 billion last year or $1.23 per share. So one of the things that impacted Alphabet in the quarter is they recorded about $2.6 billion in charges related to workforce reductions, or essentially laying off people. It's a big theme in tech right now. Companies are laying off people. They're really trying to streamline their operations and focusing on margins, which is something they have not had to do in recent years. But still a great beat by Alphabet. Their earnings per share of $1.17 beat analyst estimates by 10 cents. Revenue of just under $70 billion beat by about $1 billion. Now, Alphabet has recently released Bard AI. This is in response to competition from ChatGPT and also Microsoft's new Bing. So Microsoft has been very vocal that they are going after Google for share of the search market. Bing has been, not really taken that seriously in the past, but now that they have upgraded it with ChatGPT capabilities, they may have injected some power into it, and it's starting to get more interest. So Alphabet is seen by many as now on the defense, and it's up to them to create a response. That response has been Bard AI, but Bard AI has not yet been released publicly. So I'm personally on the wait list. I have not been able to play with it yet. I have seen some demonstrations where people have compared it to GPT-4. In some areas, it's comparable, in others, it's not. But in any event, Alphabet has a reputation of having some of the best AI engineers in the world. One of the top AI companies in the world, bar none. So it'd be interesting to see what they come out with. Now, looking forward, analysts for the current year are expecting earnings per share growth of about 15% to $5.24. And that puts the valuation of Alphabet right now at about 20 times earnings. So one of the things about investing in Alphabet is they do have the overhang of the potential of increased competition from ChatGPT and the new Bing. But that is also factored into the stock price. So 20 times earnings, this is one of the lowest valuations that Alphabet has traded at in its history as a public company. And analysts are still expecting growth this year. So we will keep a close eye on the company over the next couple of quarters and see how things trend. Next up, Amazon. So they put out their Q1 results. Net sales increased 9%. North American net sales up 11%. And AWS, which is their cloud computing service, increased sales 16% year over year. Operating income in the quarter rose to $4.8 billion, up from $3.7 billion. AWS, the cloud computing operating income, reached $5.1 billion. So this is something that we really have to pay attention to here. Overall operating income for the entire company, $4.8 billion. Cloud computing operating income, $5.1. So what is that telling you? It means that the only profitable part of Amazon's business is cloud, right? So when we think of Amazon, we typically think of Amazon.com, the e-commerce platform, but it actually doesn't make that much money. And in fact, currently it is losing money with Amazon.com. And really it's the cloud computing that has been bolstering the business. And this has been the case for some time. Certainly cloud is leading the company in terms of profitability and growth. But one thing that we also have to note with the cloud computing platform is that, well, the two biggest competitors, Microsoft Azure and Google Cloud, have been growing their market share in the high growth cloud space. Amazon is not. Their market share, although they are number one, it's been pretty stagnant at 32, 33%. of market share globally. It's been stagnant there for the last several years. And then they've also noted that cloud growth is starting to grow or slow just the overall market. So this is something to keep an eye on. But they did outperform analyst expectations by quite a margin. Earnings per share of 31 cents, beat estimates by 11 cents. Revenue of 127 billion, beat by almost $3 billion. They did put out guidance for the second quarter. They expect net sales to grow between 5 to 10% year over year. Cloud computing, of course, once again, this is the primary driver of growth and profitability. So, it is somewhat concerning that they're not able to grow their market share in that space while their two next largest competitors have been. Looking at analyst estimates for the current year, the midpoint of consensus is for Amazon to generate earnings per share of $1.54. This is up from a loss last year. And this puts the valuation of the stock at about 66 times earnings. So Amazon has always really been the most expensive of the big five. Whereas if you look at Microsoft, Alphabet, Meta, Apple as well, the valuations have been fairly reasonable. Whereas Amazon has always traded at a big premium to the market. It also has a more levered balance sheet than the other companies. So generally speaking, Amazon has been our least favorite of the group. And then there's Meta Platforms, finally. Meta, formerly Facebook, released their Q1's 3% year-over-year revenue growth to just under $29 billion, driven by a 26% increase in ad impressions. However, the average price per ad has declined by 17%. Net income was down. Earnings per share were down for the quarter. They did report a 5% increase in daily active people, daily active users. And Facebook monthly users also increased by 2%. Now, Meta's talked a lot, has been very active with respect to laying people off, as many tech companies have. In March of this year, they announced 3 rounds of planned layoffs. They want to reduce the employee count by about 10,000. That's fairly significant considering at the end of the quarter Q1, the head count of the company, the total number of employees was 77,000. And that number does not include the 10,000 that they announced that they will be laying off. But a fairly significant beat on the net earnings line. They reported $2.20 in earnings for the quarter, beating estimates by 23 cents. Revenue of $28.65 billion, beating estimates by $990 million. The stock price performed extremely well since the release of the results, up 14%. And they have also provided guidance for the next quarter, revenue between 29.5 and 32 billion. So that would be year-over-year growth of between 2% and 11%. So analysts this year have them growing at midpoint of the analyst consensus as EPS increasing 25% in 2023 to 1075. And this would put Meta at a valuation of about 23 times earnings. Looks like analyst expectations for growth next year as well are fairly optimistic. We'll see how the company does over the next few quarters.